equities are a really powerful asset class to create wealth, and they are very simple. And people complicate equities by focusing a lot more on stock selection or timing the markets. Instead, they should focus on asset allocation. And time and again, we have realized that if you overpay by a margin for even the best of businesses, even if the business does exceedingly well, the investment will not do well. So in this market, I think there is reasonable value across the large caps.
Okay.
I would only be cautious in the small and mid cap space, which to my mind are really expensive. Investor expectations have to be realistic.
Okay.
They should not extrapolate the last 5-year returns. Those high returns are mainly because of the low base due to of COVID. But I don't think those returns should set the expectations for the future.
So welcome to the Dhanam BFSI Summit, sir. It's a pleasure to have you.
My pleasure too.
Okay. So after nearly 3 decades in the mutual fund industry, what made you switch gears and start your own investment fund?
No, I think I stopped enjoying chasing targets.
Okay.
And, HDFC Mutual Fund, where I was, is a listed company, was a listed company, and there are expectations of shareholders to keep pace with the industry, market shares. So I stopped enjoying chasing targets, and that's why I said, let me do investing but without any growth targets for the business.
So over the past decade, we've witnessed an incredible period for equity investors. So I think Nifty has given over 13% average annual returns. So do you expect this trend to continue in the coming decades as well?
So I think Nifty, if you look at since post 2000, I would say it's delivered around 12-13% returns.
Yes.
I think broadly those returns should sustain because India's real economic growth outlook is decent. We should grow between 6 to 7%, and nominal GDP should grow around 11% because we are now a lower inflation country. I think profit growth should also keep pace with that because there is not much room for margins to move up, in my opinion. And similarly, multiples are very fair. I don't think there is room for multiples to move up. So I think large caps, yes, I would expect Nifty to do low double digits, 11-12% CAGR. Small and mid caps, I would be more cautious.
Okay.
Because I think that space is, to my mind, the risk reward is not as good as the large
At the
caps.
moment.
Yes.
Yes, okay. We're having our first real correction in the markets for 1.5 years. There's talk about economic growth slowdown and FII is pulling out an unprecedented amount of money. So what is your take on that? Is this a cause of concern, at least in the short term?
I think a 10-15% volatility in Nifty is very normal. It can happen even without any event. Once in 5-10 years, when you have a crisis type of an event, the volatility can be higher. But 10-15%, I would not worry too much about it. In fact, the resilience of Indian markets to FII outflows has gone up dramatically. And earlier on, we used to see markets virtually collapse. But now markets come off a bit for a limited period of time. So I think the volatility of Indian markets or the fluctuations, especially linked to FII outflows, have reduced considerably. And I would not worry about this. And any downward corrections like these should be used to the benefit of longer term shareholders.
Okay. So if you look at the global scenario, Donald Trump is back as the president of the US and already the markets, I mean, there are waves in the markets already. So what is your take on how his presidency could affect India?
So I am not very clear on that, but I think he is focused a lot more on reviving manufacturing in US, on accelerating growth, reducing government,
Regulations,
bringing
yes.
regulations, reducing regulations, reducing tax rates. So I think if this works fine, I think it should be good for the economic growth of US. At the same time, if it results in a much higher fiscal deficit for US, then it could lead to higher US yields. I think India by and large should be relatively less affected by this.
Okay.
Because our growth is mainly driven by domestic consumption and the external environment is very supportive for growth of both manufacturing and service exports. And also India's current account balances or deficit is quite low. So to that extent, even if US rates move up, I don't think it will have a meaningful impact on India. And finally, I think as we discussed earlier, the impact of FI outflows, which could continue if US growth
Does really
revives.
well.
I think the resilience of Indian markets is far better today than it was in the past.
Okay. Since India enjoys a current account surplus, a trade surplus with US, do you think there could be tariff targeting India?
We'll have to wait and see, but India is too small in the overall scheme of things. And bulk of our trade surplus comes from service exports, which actually adds to the competitiveness of US companies. So and there are not too many alternatives to the service exports that India is good at. So I don't think much should get impacted.
One thing that has balanced out the FII outflows has been mutual fund. There's a lot of money waiting in mutual funds yet to be deployed. So I think last month we've crossed a milestone. We crossed 25,000 crore worth of monthly SIPs.
Yes.
How do you see the evolution of mutual fund industry in India?
No, I think it has evolved very strongly. It has come a really long way. I mean, if you go back in 90s, to get few crores used to lead to celebrations, and today, so I think and this is a result of good regulation, making mutual funds more transparent, lower cost, more flexible, support of media, IFAs, distributors, mutual funds themselves. So I think these flows are here to stay, and I think the only thing is that investor expectations have to be realistic.
Okay.
They should not extrapolate the last 5-year returns. Those high returns are mainly because of the low base of COVID. But I don't think those returns should set the expectations for the future. And especially if you look at the taxation rates for equities far lower than fixed income. So I think there is a strong case for people to deploy long-term savings in equities and through mutual funds.
When you think about fund flow into mutual funds, do you think this is just the beginning for India?
I would not say that. I mean, the beginning was 3 decades back.
Okay.
Today, I think about 25% of household financial savings on a flow basis is getting into equities
25%.
through different formats, mutual funds, insurance, EPFO, direct, PMS, AIFs, all of it put together. I think there is some more way to go. It could go to 40-odd%. It is possible, but it will take its own time. So I would say these flows are here to stay. It's a reasonably, I would say, healthy market. There is reasonable maturity. But in terms of number of investors who are coming to equities, I think we have a long way to go.
Yes.
But the large pool of savings is probably a reasonable pool of savings is getting deployed, because the savings, aggregate savings of the lower income groups would probably be a lot smaller.
So I want to get your take on a couple of asset classes. So down here in the south, we love gold and FDs. What is your take on that?
No, I think, see, all assets have a unique characteristics and they have a place in one's life. So equities create more wealth, but they are more volatile. Fixed income gives you much lower returns, especially post-tax, but it is less volatile. And gold I look upon gold as a insurance.
Okay.
Because if things go really wrong with the country, something terrible happens, something unfortunate, then gold is an asset class which will preserve your purchasing power, even in very tough environments. So I think the key is how much do you invest in these 3 asset classes. And my take is, on whatever portion of one's wealth, you can tolerate a 10-15% volatility in the normal course in any given year. And in a crisis year, which typically happens once in 5-10 years, like a Lehman or a COVID, temporary downfall can be even 20-30%. So to whatever extent of your wealth you can tolerate this volatility pattern, that should go to equities. And that portion of wealth which you don't want volatility on goes to bank FDs. And today there is no difference in taxation between a bank FD or a fixed income mutual fund. So to that extent, bank FDs are really good on the safe part of your capital. And And I think some portion of your wealth, whatever one decides, 5%, 10%, around that can be parked in gold. And if you do it through the gold bonds or something, I think that is also equally effective.
So I want to get an insight into your investing principles. So what is the guiding principle of your investment philosophy?
I think the investment philosophy at our end is really very simple. And we aim not to buy a weak business, a business that may fail, that may suffer, that may not do well in the marketplace at any price. So we want to buy only those businesses which can sustain, which can grow, which can compete successfully in the marketplace. That eliminates or reduces sharply the chances of a permanent loss.
Okay.
And the second thing we focus on is the price what you pay for a good business. And time and again we have realized that if you overpay by a margin for even the best of businesses, even if the business does exceedingly well, the investment will not do well. So I think we focus equally on buying only good businesses and not overpaying for them by a margin with a medium to long term perspective. Remain diversified, have a low churn strategy, and this has worked generally for me.
Are there any key metrics that you consider when investing or selecting a stock?
See, the source of comparative advantage can come from various sources. It can come from being a first mover, it can come from scale, it can come from processes, from culture, from brands, from technology. And when it comes to valuations, I mean, you can look at price to book, link it to ROE, look at P multiples, link it to sustainable growth rates.
So over the past 3 decades, you've consistently delivered exceptional returns, huge market outperformance. So, and you've done so by identifying and selecting key themes which have done really well. So looking ahead, what kind of themes are you seeing that could create potential wealth for investors?
See, one, that outperformance was not every year. There have been periods in that 3 decades journey which were not so good, but over time we made up for that entire underperformance and the end result was extremely good. I think in these markets, these are very unique markets in the sense one is not able to identify any deep pockets of deep undervaluation. And up till now, whenever markets were high, whenever multiples were high, there were some pockets which were undervalued. And in these markets, the dispersion in valuations across sectors is really low. So I think there are no pockets of deep value. Still on a relative basis, I think the large banks look relatively better placed.
Okay, all right. So up until the correction, I think a lot of investors were finding hard to deploy funds because the markets were richly valued. Were you also finding that to be the case?
See, I think we have reduced exposure to small mid cap sharply, and we have moved mainly to a large cap oriented strategy. And I don't think we were finding it difficult to deploy capital, but I think we were working hard communicating with our investors to reduce their medium to long term return expectations.
Okay.
So I don't think it is fair to expect 20-25% kind of returns in these markets. I think those expectations will not be met. I think a 12% longer term Nifty compounding is doable in these markets.
Okay. Currently, 3P investment managers, the alternative investment fund, is that exclusively investing in equities?
Yes, Indian equities, listed Indian equities.
Okay.
No unlisted,
no
foreign equities, nothing. Just it runs like a multi cap or a flexi cap, long only mutual fund.
You have no plans to invest in any other asset classes or such?
No, we want to stick to what we understand.
Okay.
And
so can you mention, if possible, a couple of stocks that you're investing in and the rationale behind it?
So without getting into stocks, let me explain, answer that in terms of sectors. So as I said, the large banks are good.
Okay.
Now what is a good bank? A good bank is one which is not losing market share and which is able to attract deposits at comparative rates, at low rates. So these are banks that have a deep franchise, good brands, good branch network, and where the retail confidence is extremely high. So we find in the digital world, the biggest banks, the biggest platforms are better placed. That is something what we like. Apart from that, I think I mean, with this correction, see, this markets have corrected 10%, but IT and banks have not corrected. And these two sectors are roughly 50% of the market. So, which means that 10% correction is a result of, on an average, 20% correction in otherwise.
Okay.
So, in this market, I think there is reasonable value across the large caps.
Okay.
I would only be cautious in the small and mid cap space, which to my mind are really expensive.
Okay, all right. Have you been, since when have you been a little cautious about mid caps?
I think last 6 months we have been writing in our quarterly newsletter. Yes.
All right. So you have over 3 decades of experience in the industry and a huge performance track record of huge outperformance. So what advice can you give to investors looking to create long-term wealth in the equity markets?
See, I think equities are a really powerful asset class to create wealth, and they are very simple. And people complicate equities by focusing a lot more on stock selection or timing the markets. Instead, they should focus on asset allocation. And let me give you a very simple analogy. Sensex was 100 in 1979. Today it is 80,000. So wealth has become 800 times. There was no security selection, there was no timing. Sensex has been doubling roughly every 5 years. So I think patience is the key in equities. So I think Mr. Buffett has said that equities are an asset that transfer money from the impatient to the patient. So I think get your asset allocation right, identify your risk capital which you can hold for long periods, and be very patient with equities. Always remain diversified, and if you don't understand equities well, go to a mutual fund. They will not do a bad job at least. So I think the key is, see, fixed income post-tax should double your wealth every 14 years at 5% CAGR. Equity should do it every maybe 6 years.
Okay.
So in 14 years, 100 becomes 500 in equities and it becomes 200 in fixed income.
Okay.
And if you take another 14 years, the 200 becomes 400 and this 500 becomes 2500. So now you can see over 28 years, the gap in your wealth is 6 times.
Massive, yeah.
And what do you need to do to achieve this? Just be patient.